All right. Special thanks to everybody for hanging around for the last panel of the day. I know these days can go long. I guess it is still the first day, though. So we're going to talk about ETPs, which no one can convince me is different than ETFs. Not even the people on this. Not even the people on this panel. Maybe we'll do a quick round of introductions just to show our bona fides on ETPs, ETFs.
Sure, I'll start. Everyone, I'm Will Peck. I'm head of digital assets at WisdomTree. We're a global ETF and ETP sponsor with a business in the US and Europe.
Hi, everyone. My name's Russell Barlow. I'm the CEO of 21 Shares, a issuer of crypto ETP in both Europe and the US.
Eric Balchunas, Senior ETF Analyst for Bloomberg Intelligence. We use ETF, but ETP, just to define this, exchange-traded product, it generally means ETFs, ETCs, and ETNs. There's just a couple twists on the structure, but ETP to me would be a little slightly more professional way to put it, but ETF is the more connotative way to put it, which is fine too.
Yeah, I'm not convinced.
I'll try. Give me a minute. I don't want to bore everybody. This is really boring. All right.
Well, I can't compete with him. So I'm Mognetti. I'm the CEO and co-founder of CoinShares, asset management company in digital asset.
Right. So just to the group, whoever wants to answer it, the number one question I have is, why do ETF, ETP market makers make Bitcoin go down every day?
Listen, you got to get off of Reddit. These crypto people, listen. The ETFs, honestly, if you have a lot of crypto in your account, you should be getting on your knees every morning and saying a nice thank you prayer to Larry Fink and the rest of the ETF people. You have no idea what they're doing for you. So they are not the culprit here. The market makers, they want to have no risk. They're like Vegas. Vegas doesn't bet on red or black. They just want you to bet. They take a tiny cut. It's the same thing. Nobody's screwing anybody here. All that happened from the ETF standpoint is you guys got about 56, 57 at this point, $1 billion in net new cash from the boomers in under 2 years. So I'd say I would take that in a heartbeat. Before the ETFs came out, if I told you, will you take $57 billion without seeing all the headlines that go along with it, you'd probably be like, sure, sign me up. It's way more than we thought they'd have. And the market makers, the reason they're great and should be also honored, really, is that you ever gone to Coinbase and tried to get Bitcoin there? It's a 1.4% commission. Market makers, you can get IBIT or any of the ETFs for 1 to 2 basis points. And on the platforms, it's commission-free. So the ETFs are effectively free exposure, free to trade, and a very minor expense ratio, which is annualized. Again, we're talking nickel dime, and that's why they're so popular. So to me, the market makers, the issuers, have been a giant blessing for the crypto world. I just don't see any other way to put that. I know you're looking for someone to blame. I just think Bitcoin got ahead of itself, going up 450% in 2 years. The price outran the narrative. So the narrative started coming in, but the price had already outrun it. So you're still up 250, 70% since the BlackRock ETF was filed. So again, I think people need to take a step back, and there's nothing wrong.
Just to go back, first of all, you need a job with one of the issuer because you're very good at that, Eric. But the funny stuff about crypto Twitter is it's out of control. And I have a little story which is funny because a couple of weeks ago, there was a glitch on the Chase app on the trading side where for some reason, the Chase app decided to replace 57 ticker or stock with the logo of CoinShares. One of these company happened to be GMI. The Wall Street Bet page of GMI was riddled with story about what CoinShares and GMI were doing together. By the end of the thread, CoinShares was becoming ComputerShare, so we changed company completely. But that show you how the kind of crypto Twitter and the Reddit and the Wall Street Bet can completely reshape the narrative and start having some story about Jane Street running a 10 a.m. bot and this guy having this other 9 a.m. bot and all crashing the market at the same time. So, very much with Eric on the value add of the market maker in this liquidity. And if you look at the liquidity of the digital asset ecosystem pre and post ETF, it's day and night. And yeah, it's true today, you better hold IB than trade on Coinbase.
So what I'm hearing is that coin shares is why Bitcoin goes down every day. No,
It's a good headline. So.
all PR is good PR. So do ETFs get any blame for the weakness in crypto generally and Bitcoin in particular recently?
No, I'm not sure ETF get blame. I think with ETF actor changing, if you look back, the stuff is past, present, and future. So the past is 2015 in Europe, and 2015 the very first ETF came out in Europe, and basically the entire AUM is retail player. There is not a single person of a risk management team looking at the position. And so as the kind of maturity evolve and how you see the development of the different kind of players, well, crypto people were dying for institutionalization of the ecosystem. Well, now you get proper hedge fund, you get proper asset allocator, which get a risk management team. And when the risk management team say you out, they cut the position as well. The retail kind of switch off the screen and forget. So very different people, very different market structure, market narrative, market sentiment, and that all echoes in the kind of price action you see today.
I will say one thing on the Jane Street concept, the 10 a.m. dump, so to speak. That did feel real, I'll be honest. Didn't it seem like for a couple months there, Bitcoin would rally overnight, and then it would just crash 1,000 points at about 10 in the morning? And the time wasn't always 10, but it just felt like there was something working against the rallies. It really did. Now, I don't know if that's true or not. We have no way to prove it. But when Jane Street had that lawsuit against them, and there was rumor that they had taken a step back from crypto market making a bit, it did seem to get rid of a boogeyman. Whether it's real or not, getting rid of a boogeyman is very good. And so I think Bitcoin does trade on feeling and sentiment and vibe. And so I think that was very helpful, whether it was real or not. But I think net, all these market makers, remember, if they go long or short Bitcoin or try too hard to take a position, if they short it and it goes up a lot, they're going to be in trouble with their managers, okay? But the Jane Street one looked to be like maybe, okay, do you lure people in by dumping or raising the price and then you dump it? I don't know. I mean, markets can be pretty crazy, and there's a lot of people trying to do a lot of things. But I think net, you have to take a step back and just look at, again, since BlackRock filed that ETF, and remember, that was right in the, I use the word stench, it's a little harsh, but in the stench of FTX was when that BlackRock ETF filing hit. And I think the Bitcoin was 15, 20,000, and now you're at 70. Again, let's just say we said you're going to be at 70 in 3 years from there. You'd probably be like, that sounds like a pretty good deal. It's just this roller coaster can feel pretty wild. But again, you went up 450% in 2 years flat, which is almost too much. I mean, and no asset really should go up that much. So net, you have to look back and go, okay, what's my 5-year return? And again, I think it was all pretty net positive, both the market makers and the issuers, in terms of really being a bridge to the regular world. The boomers who have all the money, by the way, and they're starting to get invested. The wealth managers who control $45, $50 trillion in the US, they trust ETFs. This is their vehicle of choice. So just don't overthink it, I think, is my message. You've got all these wholesalers from BlackRock and Van Eck and CoinShares and WisdomTree. A lot of people, smart people, they speak boomerese fluently. They know how to use Sharpe ratio and terms like that. They are slowly out there bringing the message to these people. Don't worry about the price so much every day or even every year. I think it's hard to bet against that sort of wholesaler army and the Wall Street apparatus being on your side.
What I find a little funny here is that I feel like the last time I heard people blaming ETFs for price action it would be U.S. equity market bears who were blaming ETFs for driving U.S. equity markets higher, right? It just doesn't, it reflects a fundamental misunderstanding of how these ETFs work and the nature of the arbitrage mechanism, right? Where, so it's just kind of funny here that when it's not going people's way, they're like, oh, the ETF is now driving prices lower. It just doesn't really, it's inconsistent logically to me.
Well, what had changed, however, is the entire derivative market on the back of the ETF. You didn't have all this kind of option market before. The option market has completely exploded. it creates a gamma exposure to the market, which has completely changed the dynamic of the market itself and the market maker action as well. And so if you look at it with a past lens, effectively, at how the market is reacting today, you don't understand the market today, but that's because you get all this hedging activity happening as well. And so the market structure is changing, the infrastructure around it is changing as well. And as such, you need to get some new catalysts and new dry money, which is slightly bigger than before to keep pushing this market in a different direction.
Can you give us the ELI5 version of how the market structure has changed or what impact that's had?
Yeah, very simply, all these option, effectively, market makers and option sellers need to hedge the position as well in kind of the physical market or the IBIT market or the ETF market, and all this kind of hedging on both direction, both on the way up and on the way down, create this kind of compression of volatility as well that we're seeing today. So it's completely changed the dynamic of this market.
I think it's also a function of, when you look at the original kind of early investors, a lot of people invested either on the idea of a fundamental belief or on a speculation, and a great way of investing would have been through the centralized exchanges. The ETFs allowed investors to then think about an allocation more from a longer term portfolio perspective. But what that's facilitated is a demand now for more professional investors on the prop desks who actually have much more sort of availability of tools from derivatives that can allow them to take these leverage futures perpetual positions, which then creates this much greater volume of demand for Bitcoin than actually might physically exist. But that's not that different from what you see in traditional markets as well. CDS, for example, thinking back to the global financial crisis, which is not probably a great analogy, but you had a lot of kind of mortgage derivatives that was far outweighing the actual mortgage contracts out there. So what's happening is just a professionalization of the way in which investors are using crypto assets and the development of that market infrastructure. But with that become sophisticated players who, to Eric's point, are not necessarily interested in that long-term trend, are just more interested in capturing a spread, hedging a book, and that can lead to dynamics that don't look particularly normal from that traditional investor's perspective.
There's another thing called the basis trade, which again is part of the structure, but that's good. You know, arbitrage is like this dirty sounding word, but to me, I've always used the metaphor. It's like when a farmer puts a snake in the cornfield because it eats the mice. Nobody likes snakes, but when they eat the mice so the corn lives, then it's good, right? Arbitrage is a natural incentive for someone to go short this and long this to take the spread, right? So futures sometimes will have an arb advantage in them. So you can short the ETF or buy the ETF and short the futures. That basis trade has been, I don't know, maybe 5% of the flows and activity. So there's a little something that's different, I think, that wasn't quite possible before. But because ETFs can be created and destroyed, you can arbitrage them. And this is, arbitrage is the secret sauce to the whole ETF ecosystem, frankly. That is why you log on to your Schwab account. Well, you guys probably don't have one, but most people log on to Schwab and they can buy Microsoft stock or ETF at a nice spread, 2 basis points. It's very useful to have that, and that is because arbitrage. And the other thing I would say is that paper Bitcoin is another one of these sort of like Reddit theories. Listen, these ETF issuers have been doing this for 33 years. There is no way they would not deliver the Bitcoin to the custodian. You guys are issuers. You really want to be short or long your underlying asset? That's just not what they do. You guys are the issuers. Are any of you?
You can't. Legally, you can't.
Legally, you can. But I know that doesn't always stop things in crypto if it's illegal. But legally, you can't do it, and they wouldn't want to do it. So all of the Bitcoin, the $100 billion the ETFs have in Bitcoin, maybe it's 90 billion, something like that, it's literally 1-for-1 with the custodian. You guys have anything different on that?
No, you're right, fully collateralized. A lot of people now like to use the word physical in the title just to clearly define that. There are futures-based strategies out there on Bitcoin, but for us as issuers, fully collateralized physical ownership of the underlying. And as was mentioned, from a regulatory perspective, it's a requirement. That doesn't mean that collateralized lending could happen in the future, but it's not something that you would do on an uncollateralized basis.
What about the idea that adding derivatives and ETFs and things effectively expand the supply of the underlying? Is there anything to that?
I feel like we just touched on that same point. Yes, it can, and it happens in other asset classes. I don't think it's something that's going to be unique to crypto. But as issuers in our product range, what we do is fully collateralized, so not something that's facing us.
Well, there is only 21 million Bitcoin, so we're not expanding the Bitcoin supplies, we're just expanding the trading volume. So Michael Saylor is the best example of that. He's just an alchemist of Bitcoin and creating this kind of narrative where repackaging Bitcoin from equity to digital credit and keep moving it along the curve of different investment share class. Now, if you look at gold spot, or gold which is in vault, or gold which is in the ground as a non-reserve, that's just the amount of gold which is trading every single week on the stock exchange. It is not exactly comparable, but at the end of the day, it's a function of offer and demand and exchanging at a price.
Yeah, this idea that just because there's derivatives, I don't know if it dilutes it any more than it would for shares of Microsoft or gold. Again, gold ETFs are probably your closest benchmark. I mean, they are the guinea pig for what's going on with Bitcoin. It's very similar, same structure. It's a commodity, no cash flows. And I wouldn't say that gold having, or GLD having derivatives has really affected overall the price of gold. The price of gold moves on more macro conditions like it should. So I wouldn't really worry about that. Derivatives have always been a part of these markets. It's not going to dilute anything. Again, I go back. It's just interesting to me looking for these, like, what went wrong. And I'm like, you're literally up like 80% annualized since the ETF was like, what? I mean, it's wild. I don't know, like, what's the word? Like the dark cloud that I saw over the past year. I mean, look, man, you can't go up like 250% a year every year. And I argue with these people on X. I shouldn't, but I do. I can't help it. Because I'm like, you should hang out with a bond investor, okay? They're happy with 4% a year, all right? It's like, get some perspective here. I know that's harsh, but I just trying to be like, everything's fine. Like, you've killed everything in the past couple of years, but you went up too fast, too soon. You got too close to the sun at the end of 2024. So you came down a little bit, and there was probably some people front-running the 4-year cycle. And I think some OGs are now older, and I like the concept of the silent IPO. The ETF is kind of like an IPO moment. And if you're the kind of person who hung through a couple of the drawdowns in Bitcoin, by all means, you deserve to cash in a little bit, because those are like, there's that level of discipline to survive those drawdowns is, I tip my hat to you. Almost no real, like, it's really hard to do that. So a lot of people, I think, are, cashing in. Maybe they're buying like a house or something, and they're older. So I think silent IPO was also a little part of it. And I heard also some of the OGs wanted to get income, so they did a covered call strategy, which is a natural blanket on the price too, which is to sort of sell calls right outside of the money. So if it goes up, you don't get the upside, but you get this nice premium. And that covered call trade was, I think, another reason that the price had trouble, like, having one of those, like, God candle moments. But again, all this is pretty normal. The returns annualized since the BlackRock ETF was filed are tremendous, even with the 50% drawdown.
I mean, what may be different than gold is just like the availability of leverage in the crypto space, right? Where, as this was happening, people can just easily lever up kind of at pretty insane ratios, right? Which leads to kind of violent moves up and violent moves down. I mean, I'd be interested, Eric, if you remember, like, how when GLD came out, right? And a lot of people say that's what made ETFs like really become a thing, was that for the first time ever, people could access gold in their, like, in this kind of their brokerage account in kind of the same way they buy stocks, right? Helped kind of make ETFs the force that they've become today. But I don't think the moves were as violent then. I mean, gold might just be a less volatile asset kind of on a permanent basis. It's been more established. But the moves up and down in crypto, I think you could look at the availability of leverage and attribute some of the volatility to that.
Also, age. Don't underestimate. Bitcoin is 17 years old. It's literally a teenager. Okay, gold is 5,000 years old. It was in the Bible 400 times. I mean, that's old, right? So it's moving like an old, really ancient person. And Bitcoin is, again, moving like a teenager. So derivatives are not. I just think that's the bigger reason there's more volatility with Bitcoin. It's younger, hasn't matured yet.
I actually love that point around that kind of definition and understanding of an asset class. So gold's been around for 5,000 years, real estate's been around for 3,000 years, say, and yet only in the last 50 to 100 years have they been considered an asset class. Crypto has been around, let's call it 20 years, and today it's being adopted as an asset class. There hasn't been anything faster, in my knowledge, that's come from existing to being able to be incorporated in a portfolio as an asset class. And that's disruptive and a game changer, and something that I think for the future for the ETF industry is really powerful, because for most allocators who want to include a new asset class in their portfolio, ETFs are the great wrapper and the access route to sort of build that exposure. And thankfully, we haven't had to wait thousands of years for that to happen.
What about all of these new ETF holders of crypto? Is there any evidence yet whether they are more or less paper-handed than say an owner on Coinbase or something?
They bought from someone, right? Like, isn't that the point that like when they came in, they're buying from somebody who's clearly by the nature of selling it to them, not diamond-handed? It seems hard to kind of generalize based off of that.
What I do like about that, though, is that I do believe that they are two very different clients. It's an investor that's buying the ETF, and it's a speculator who's buying through the centralized exchanges. And an investor wants to hold it alongside everything else it holds in its portfolio. So the ETFs are a great wrapper because it sits there alongside all of your other investments. You get a single valuation, you can get buy and sell it on exactly the same infrastructure that you buy and sell everything else. So I think it has broader an investor base that has a much more longer term time horizon. It could be the same investor, but they'll have speculation in one account and long-term asset holding perspective in another.
I disagree with that, actually. I think you get both kind of investors in both type of accounts. You can have a LMAX, sponsor of the day, long-term investor, and then 21 share long-time investors, and the reverse is true as well. Like, I was a very long-term investor in crypto, and facing the risk of kidnapping in France these days, you prefer having like an ETF, and plenty of long-term holder of crypto has been switching to ETF. So it's, you know, people change their mind, people go and back between different structure.
But I think the difference here is, back in the day, the only option was for any holder to own it through the centralized exchange. I think that where I see a differentiation is the size of the capital people are willing to own.
Oh no, the only option was not centralized exchange. The only option was peer-to-peer.
Yeah,
it was like you were meeting a guy at the corner of the garage to exchange crypto on a paper wallet. So it was very, very old days.
But now I think people are
not in the
concerned
Bible,
about the custody side when you're doing it self-custody or through these exchanges. And so that's where the ETFs, from a scale perspective, allow people to feel more comfortable having a larger allocation.
The ETF also, you're both right, and I think, I'll just add to this. The boomers, I said this from the get-go, they're going to be stronger hands than people think, and they were. In this drawdown, 50% drawdown is insane, by the way. I mean, not even the stocks went down 37% in 2008. And then in COVID, they went down, I don't know, 14% in a month. It was pretty bad. But 50% is, within a year, is crazy. And only about 7% of the assets left. So that means 93% of these boomers hung tough. I'm actually impressed, because when gold went down 40% about 10 years ago, a third of the people left. Now they came back, and that's fine. You know, people go and they come back. It's as long as liquidity is there, the ETF's always open for business. But two things are different here. One, the people who bought the ETF early were probably waiting for it. They were like Bitcoin fans, and they were like, I can't wait till there's an ETF. That's the format I wanted it, and they bought it. So they're probably a little more understanding of the story. And the second thing is, these boomers are not going all in. You know, as I started to get into this world, I went on these podcasts, and these guys were like, you know, in their 20s and 30s, and they were all in on Bitcoin. I'm like, you don't own any stocks? And I was shocked. They don't own stocks and bonds. They think that whole world is a scam. I don't think it is. I think both worlds have merit, but the boomers are only putting 1% to 5%, probably 1%, into Bitcoin. And stocks have done very well when Bitcoin had this drawdown. So to them, this is like no big deal. It's like stubbing your toe in a portfolio, big deal, because it's only 1%. The other thing is, if you buy an ETF, you are smart, okay? ETFs don't pay any brokers off. There's no, they don't grease palms of brokers. There's no way to do that. People who buy ETFs have to find them. And they tend to be heads-up investors who like low costs, and they know what they want. So they're like the high-level consumers. Those people tend to know about behavior and portfolio constructions, and they work with their advisors a lot. And that's why I think they're stronger than people think, not to mention these boomers have seen some things, okay? They know things go up and down. They've seen many different cycles. And so put all that together, and I think you have a much stronger set of hands. And thank God, because if the boomers had panicked in this drawdown, you'd be down 70%. It'd be a lot worse. So at least they held tough during this. I think, and I said this already, I used the meme, the call is coming from inside the house. I could look, who among you was doing the selling? It was the OGs. So I tried to push back on this in the online exchanges I've had, and I think I'm right.
No, you're absolutely right. And the OGs and the miners who have been very big sellers and net sellers continuously during the whole drawdown.
So if the holders of Bitcoin are less OG and more boomer, does that change what Bitcoin is? Since Bitcoin is just kind of whatever we think that it is?
Now, a lot of OG get married, a lot of OG get a wife who wants diversification. You need to be able to buy a house, you need to be able to provide security. Just saying your portfolio is down 70% is not a good excuse anymore for a lot of them, and Miami is going up. So you have to be able to justify this new lifestyle. All jokes apart, as people mature, they also change the diversification. And, there is still some very, very strong OG like Adam Back who have been buying every single treasury company coming out. But a lot of the guys who were earlier allocators are looking at diversification, setting up family office with management coming up in family office. Like, okay, how do we build a portfolio which is a bit more diverse? Not exactly the all-in that Eric was mentioning. And all this stuff is evolving. So it's a natural evolution of this kind of OG players into much more sophisticated institutional investors. Just took Arthur, which is the founder of BitMEX, is now becoming a private equity investor. You can't really do private equity investment in Bitcoin. So all this kind of stuff was just fine.
Anyone here Gen X? Gen X generation?
Define Gen X.
Okay. You remember the 80s. Okay. Anyway, you know if you are, believe me. Even though the New York Times will be like, boomers, millennials, Gen Z. I'm like, hey, what about us? We've been ignored. That's why the music is so good. Anyway, you remember in our generation, selling out was like a big deal. Remember like Reality Bites? Ben Stiller sold out, and like Ethan Hawke was like the cool guy who never sold out. It was like a whole theme. Nirvana is a great example, and we have a book coming out where we use this metaphor. The OGs are like the hardcore punk people in Seattle who got to see Nirvana at some like destroyed dive bar. And when Nirvana signed with Sub Pop, it's like, yeah, they're one of us. But then Nirvana signed with Geffen and went major. And it pissed off some of the local Seattle people. They're like, oh, they sold out, F them. And meanwhile, Nirvana went on to bigger and better things. What? Because they're good. Good things tend to go mainstream, right? And there were some people who were like, I can't listen to Nirvana anymore. This happened to a lot of 90s bands. But Nirvana, again, selling out bigger and bigger arenas. And the music is the same. It's the same music going into people's ears. But yes, they got bigger. So Bitcoin, it's always been the same. Bitcoin is the same thing. It's always been. All that's happened is it went mainstream, and the intermediaries got a little more professional. And it's probably a good thing. FTX literally lost people's money. Now you've got Larry Fink. He's not going to lose your money. You can trust them. It's safer. So all you got was an upgrade of better intermediaries and more actual audience. The cost is some of these cypherpunk, hardcore OGs. There could be a couple who are turned off. And that may be the price you have to pay for going mainstream, akin to Nirvana losing a couple original fans. That's my metaphor for what's going on right now.
But actually, to your metaphor, if you see the old debate over the winter or autumn and winter around Zcash and how Zcash was so much more powerful than Bitcoin because it was Bitcoin for privacy layer, and that was all driven by the OG, mostly Tyler and Cameron Winklevoss, who sold all the stash of Bitcoin in the meantime. And so it's quite spot on, actually, as a metaphor, because that's completely reflect that.
And by the way, if you are an OG and you don't like the privacy issue, go use the ETF. It's totally anonymous. No, we don't know who's doing the trading. Nobody can track you if you sell or buy your ETF. So just FYI.
One thing I've found kind of funny historically with crypto Twitter is like when people are complaining, they're railing against banks and traditional finance institutions, and then like JP Morgan is doing like some minor thing with Bitcoin, and then people are like celebrating it, saying it's going to send it to the moon. And I feel like you see that time and time again where, I don't know, people like the price to go up. Like, and I think that's kind of like a fun, like some people are probably in it truly for the religion, and a lot of this, like, I don't think they're going to be at Digital Asset Summit. I think for everyone else, they wanted to get in early, they wanted the price to go up, some people kind of fall out, et cetera. I think that's just kind of the circle of life with this.
But I do think that there's a distinction between groups like us who provide exposure to the asset, but don't actually operate the asset, and these more crypto native OGs who actually understand the infrastructure and probably needed to operate, to provide governance, to provide...
Actually, not to be sneaky, but 21 share got acquired by Falcon X, so the group do operate the asset, so just to be transparent.
What was that?
I say 21 share got acquired by Falcon X, so the group, as you say, operates the asset, so you are part of the operators.
Yeah. But I'm talking about kind of the groups who originally founded or sit behind the actual protocol. They're needed to kind of operate, run, manage. That's an infrastructure that from us as issuers, we're not as connected to. We're providing clients with exposure to that asset that they see as an asset that's likely to appreciate. And that's why they're looking to sort of to own it. Now, we do have legitimate reasons to engage around staking, network updates and votings, etc. But actually kind of the infrastructure that sits behind it is not something that the Blackrocks are going to be involved in sort of providing input and validation on.
One point of clarification, Eric, is the book you're writing about ETFs or about 1980s rock?
Both. I can't help but put music metaphors. The fund business is very akin to the music business. CDs are like compact discs, Spotify is like ETFs, and there's different genres and different formats to get it in. So it's worked very well for a long time. I just grew up in, I'm an MTV kid until they started going to these like dumb shows. They play videos. So I have like a whole childhood foot of that. So I'm like, I need to use this for something. But the book is I wrote with James called Both Sides of the Coin. It's just basically a fair and balanced look at Bitcoin and the ETFs and the financialization of a lot of what we're talking about here. We just think, Pete, it's time for people to kill their anchor that everybody anchored to some thought in like 2017 on Bitcoin. Forget that. Cut your anchor. Take a fresh look at this space because it's more interesting than you think, and it's coming to your 401k. So we just want to cure future regret. Look, read the book, hear the pros and the cons, and don't buy it, and then don't kick yourself when it goes to $1 million. Or purposely buy it because you think it's worth something, and if it goes to like $10, you won't be mad either. So we just want to cure future regret, and we feel right now people are going to be, they don't know enough. My mom called it funny money in space. And I'm like that's what she thinks?
It's pretty accurate.
The publisher wanted me to call the book that, by the way. I was like, nah, I mean, it's good. We have a section called that, but that's a little much. But she was open to the idea of a global currency. She's worried about debt. She had some of the openings, but she just was anchored to some BS from like, either FTX or some other, people think gambling. So it's time for people to really like take a fresh look because it's now coming at you wherever you are.
What about looking forward for ETFs? I'm not sure what we're debating now on ETFs. Is it like what gets approved now or?
You need to ask the Dalai Lama of ETF.
The only debate really is how many coins they'll approve. Like, will they approve a Trump coin ETF? But this is nickel dime kind of niche stuff. There's not really a lot to debate here. They've basically, since Trump won, the SEC's gotten way more liberal, and they basically approved almost everything. So it's pretty much floodgates are open.
Yeah, and I think that there's a sentiment change as well, interest in yield and income. So that could be an angle for new products and exposures. There's the concept around sort of multi-asset that includes crypto and traditional assets. So I think there's product evolution that can come. Single asset spot products are very very prominent at the moment, but I think there's going to be a broader range and blending assets together.
I think it's to be, what do people want, right? Like, I think in the past past administration, certainly, there was clearly demand for Bitcoin, spot Bitcoin ETF. And that's obviously been very much observed over the past few years. But like, what do people want to invest in? And I think the ETF doesn't magically mean that there's going to be inflows, right? People launch ETFs all the time that don't kind of get traction and stuff like that. So I think now on a level playing field, like, we're going to see, what do people actually want to invest in? What do gatekeepers allow? Which is going to be an important thing too, especially in a wealth market like the US. So I think that's the debate. It's just like, what products do people want exposure to? And we'll see what the crypto market looks like in 5 years. Like, I think certainly Bitcoin's still going to be here, but there's going to be a lot of change and turnover beyond that, I think, potentially. Not trying to make a statement there with like Ether or anything like that, but I think that's going to be the thing to watch out for over the next several years.
Okay, maybe for the last question, I did ask ChatGPT what questions I should ask you guys. I did not use any of them because they were all pretty terrible. But ChatGPT does this new thing now where at the end it says, do you want to know whatever? And it said, do you want to know what a question Eric Balchunas loves to answer on crypto panels? So here we go. The question is, where does the launch of BTC ETFs rank in ETF history? First of all, do you love that question? And then second of all, what's the answer?
I don't love the question, but as an analyst, I've been covering this space for over 20 years. And before that, I covered mutual funds. So I have like this whole track record of like just watching the market. Plus, I read about what happened before I started covering. So in 33 years, there has never been a launch like this. So IBIT, it actually touched the $100 billion within 18 months. Now, to put that in perspective, the next fastest ETF to hit that mark was like 5 years. So it was like 3 times faster, and this happened at 50 billion, 60, 70. It's ridiculous. It's not like just barely being faster. It's just like, it's like almost like a freak of nature. So I told the Ether people, hey, don't expect that. And then I told the Solana people, don't even expect that. Because as you get further away from Bitcoin, it's going to be like more normal, but they're all pretty big hits. But Bitcoin, those ETFs were just unbelievable. And as an analyst, you know, our jaws are dropping. We can't believe it. Even the options market, when they had options, that crushed all the records. And the volume and the number of institutional holders, there's now 1,200 or something, I think in IBIT alone. That's crazy. So all of these things are way beyond anything we've ever seen. And so as an analyst, I don't know, it'd be like Michael Jordan coming along in basketball. It's like, I've never seen anything like this, and I'm a sports analyst. Of course, I'm going to be talking about it for a little while. And that's, I don't know. So I don't say I like the question, but what am I supposed to do? That if you were an analyst of an industry and something came and just like destroyed all the records, would you talk about it a lot?
Sport, music, you're too good. But, you know, the first filing was 2014. So 10 years of starvation in the US, and you get the biggest show in the world.
All right, unless we have any more books to pitch, I think we can call it.
Or CD.
Or CD, or any musical endeavors.
Musical, Eric?
Oh, okay. All right, that's a wrap for day one.